we are going to go straight into our next panel, which is particularly interesting in the light of what we've just been hearing. We started today talking about property as an investment option, but property is, of course, just one option, and there are so many others where the risks have to be weighed before the money is allocated, and that is such a challenging thing right now, possibly more challenging than it's actually ever been. I mean, we've just been talking about how we really don't know what's going to happen in the US-China trade relationship. We are in a generally low growth, low inflation environment, and it is increasingly volatile. I don't know whether you've caught up with today's GDP numbers. In Australia, we grew 1.4% over the past year. The optimist would say that that's our 29th year of expansion. The pessimist would say it's our lowest growth rate since 2009. But it does go to illustrate some of the challenges about where we put our money. So for this session, again, do remember to add your questions onto the app. If I can ask my panelists for this session to join me, that would be terrific, because I'm not going to run it on my own. You'll be incredibly pleased to know. And as they're coming up, I'll put the poll question to you. Now, this is going to take a while. How dynamic is your asset allocation strategy? Now, unlike our first question today, which was really quite simple and didn't have any dependence on it, this particular question has got a very detailed series of potential responses. Can we get the poll question up so people can see what the options are for their responses? Well, in the lieu of that, here we are. Right, there you go. It's very complicated. You've got static with occasional dynamic tilts, static with regular dynamic tilts, dynamic only, none of the above. Or maybe you should have all of the above. That is something for you to think about while I introduce our panel this afternoon. On my right, I have Daniel Gerard, who is Head of Investment and Risk Advisory with State Street Associates. Next to him, we have Emma James, Manager of Investment Risk and Analytics at Funds SA. And at the end here of the table, we have Raewyn Williams, who is Managing Director of Research Australasia at Parametric. Please join me in welcoming our panel today. Now, I did want to say, let's have a quick look at the poll results. I do wonder whether anyone's actually managed to get their heads around them sufficiently to... Oh, there you go. Static with regular dynamic tilts wins, with static with a... Oh, no, there you go. If I keep talking, it'll keep changing. Anything in those results that surprise you? Dan, I'll start with you. Anything that... You can see them down on the screen there.
I think that sounds about right. I think that as much as we expect people to have, or people would want to have a dynamic policy, it's very hard to implement. The process in actually coming up with changes in a framework for making changes is difficult, and you need to get it through a lot of stakeholders. So I think that makes a lot of sense that it's a desire, but it's hard to implement in the real world.
Do you, Raewyn, do you agree?
Yeah, definitely it's the governance impost that is the practical constraint on more dynamic approaches. That said, you know, to me it's interesting that 15% of respondents don't have sort of a long-term policy portfolio in mind. It's purely dynamics. That sticks out for me.
It's good to see, though, isn't it, Emma, that only 5% are static.
Absolutely. There wasn't none of the above to begin with. That had me slightly concerned. And I challenged the dynamic. What horizon are we talking about here?
Well, indeed. I mean, we specialise in this with these poll questions, the lack of parameters around them, just to get the conversation going, which we are now going to do with allowing each of our speakers to give us a little bit of a rundown on how they see the asset allocation strategy of the future. Dan, if I can invite you to be first up.
Thank you. Great, thanks very much, Ali. Now, we got the slides up? Fantastic. So in a topic like this, in asset allocation, asset allocation can be a bit of a technical subject, a dry subject, unlike the previous one when we're talking about personalities and governments and dynamic changes in the way we're viewing the world. This can be, especially from my perspective, coming at it from our academic thought leadership team at State Street, it can be a bit dry. I'm going to try to change that a little bit and keep it a little bit more colloquial and lighter. By doing that, I'm going to simplify a few things and try to make it not too complex or technical, but I don't mean to minimize it in any way. It's just that we need to have this conversation sometimes approximate or think about the least complex situations. But we can always talk about some of these details afterwards if it's a bit too, if we didn't go into enough detail. So I think the first thing to talk about when we're thinking about asset allocation is what it is we're actually doing, how do we do it? So everybody has a different way of thinking about asset allocation, but if I'm a superannuation fund, I'm an asset owner, I need to think about what are my choices. So I take all of my potential assets and I throw them on the floor and they shatter up a little bit into sub-asset classes, and I might have my equities bucket and my fixed income bucket and my something called alternatives bucket, and we can argue if that's an asset class or not. But then those break down into international equities and domestic equities, et cetera. And then I need to take all of those ideas and I need to try to estimate what they might do in the future. I need to think about what kind of return I might get, what the distribution of that return is, what kind of risk is in each outcome. And then thinking about all those, I come up with a framework and I put them together and I get a portfolio, and then I need to discuss that with my board and the committees, and I need to take certain questions and then we make adjustments, and in the end I've got a portfolio. And what I don't really want is that portfolio. It's not the portfolio itself that I'm trying to get, it's the distribution of the future that portfolio represents. So once I have that thing in my hand, the amount of the time it's taken to get there, I end up with some changes in the real world around me. And I need to think about, does this portfolio still make sense? And what I really want, the theoretical solution would be some ability to revise that over time. That's a lot easier said than done, though, because of some of the things we just mentioned. There's a governance process. I need to do all of these estimations. And that real-world solution is hard to implement. So what we get is some operational difficulty, and we need to think about changes in how we adjust that portfolio going forward. So I need some flexible policy, and I need some governance to adjust that policy. So what I'm going to do today is we're going to talk about, in the next 10 minutes or so, 4 different ways that we can think about putting in a framework, or maybe the best way to say that is to think about 4 of the components in asset allocation which we can actually implement relatively easily. And I'm going to go through these, and they're actually, as we go through them, they're probably increasing level of detail. We'll start out a bit simple, and then it'll get a little more complex as we go, but don't worry about it, not too much. Okay, so the first one we're going to think about is how to optimize our overall outcomes, or how to think about what we're doing. Second is, when we're thinking about, once we have our asset allocation, we need to choose our managers and choose the inputs into that. How can I think about evaluating those managers? Third, this new subject, in the past decade or two, that there's this new idea that I have illiquids or alternatives or private equity, real estate infrastructure, that is very difficult to put into the same framework that I've used for my liquid assets for a number of reasons we'll talk about. And finally, how can I think about my estimation process for optimizing a portfolio versus how I think about just determining my expected returns in the future, like a scenario analysis? Is there some way that we can improve this idea of what scenario analysis means and putting some more rigor around that? So let's go through that piece by piece through each of these stories. So the first thing is, what do I do? So I have my idea about my portfolio, and I need to think about I need to think about where to start. So I need to mix and match my different asset classes and create some portfolio in the end. And I do that, and I have to use some methodology. And let's say that I use something that's been tried and tested for a long time, some modern portfolio theory, the efficient frontier, this idea that Harry Markowitz came up with almost 70 years ago, and that the idea is that risk tolerance is setting the price for risk in terms of my expected return, right? So I need to think about how much return I can get for some minimum amount of risk. This whole idea that I want to maximize my return and minimize my risk, that's an idea that's diametrically opposed to each other. So that's a way to think about absolute risk. I can choose on that frontier the best portfolio for the least amount of risk that's possible. But what's the problem with that? The problem is I might get some kind of a solution that is not like anybody else's solution or not like any benchmark. So I come up with, let's say, something that says the best possible portfolio is 80% international equities, 10% domestic fixed income, and 10% something else, and that looks nothing like anybody else's portfolio. So what's my other option? My other option is to think about this in terms of relative risk. I can think about a benchmark, and then from my benchmark, I can choose something that looks something like that. I'm optimizing to the benchmark. But then, what do I get? I might actually be getting negative absolute returns in the future. It's very difficult if you're a super. Somebody comes in and says, I'd like to see my performance. You say, well, listen, I got some bad news. It's negative. I've lost you money. But you should see Frank's portfolio. He lost so much money. Let's just look at that one for a second. That's not really tolerable either. So what we need to do is we need to think about how we can constrain that portfolio without it being an arbitrary way to constrain it. And the way we've thought about that is to think about an efficient surface, not just an efficient frontier. So we can think about looking at something called mean variance tracking error, or having two lines. We can have an absolute risk line, a relative risk line, and a return line, and that creates a three-dimensional surface where I can think about the right portfolio to choose, which optimizes all of those things. So you can think about that upper right-hand corner there. That's the highest return I can achieve. My lower left-hand corner is the minimum risk I can achieve, and then I've got my benchmark, my zero relative risk return on the side there. And now that creates this three-dimensional surface, and I can have a trade-off between how much relative risk am I willing to take or give up in terms of achieving my absolute return. And what it means is it's not just about constraining my portfolio because I don't believe in my views, but because it is really difficult to be wrong and alone. That's what really is, people fear about losing jobs and losing members, even though they might have high convictions in their views. Okay, let's leave that one for a second. And now that we have some idea of how to create that portfolio, we can think about the manager selection process. So choosing managers, this is going to get to be, it's something that's going to be even more topical as in Australia, especially with consolidation that we're going to see, both in managers and in superannuation in the near future and maybe out a decade, because there's going to be a lot of overlap in managers as funds come together. And to think about how to evaluate those, not just in a qualitative sense, but in a quantitative sense as well. How am I quantitatively understanding what a manager is doing, what their skill set is, what their factor exposures are, but not just that, how they behave together, what their overlap is. So if I'm thinking about the tracking errors of those individual managers, but then how they behave in risk-on and risk-off environments will be very important when I'm consolidating all of those funds together. So we can think about it in terms of getting some kind of expected tracking error target, and then what those managers might look like when I'm putting them together. That picture will change quite a bit as I am targeting a different tracking error. Or that chart on the left side, which is showing you that you might get quite a bit of diversification in managers given different situations. A turbulent, this is looking at turbulent months or quiet months, but we can even think about it in a different interval, turbulent years or quiet years. And what everybody wants in asset allocation is upside convergence and downside divergence. You're not trying to diversify your upside, you're diversifying your downside. And that's what's important when evaluating managers is, are we actually getting downside convergence and upside divergence? All of these things are important to look at by looking at the behavior of managers together. Next topic is alternatives. So alternatives is a really tricky subject to put into normal asset allocation analysis, because when we think about looking at the right optimal input of stocks or bonds, we can think about estimating volatilities and returns, and we have all of this information about covariances, et cetera, that we can look at long periods of history and auction type markets. But in an appraisal type market with smoothed volatility, different types of fee structures, this becomes much harder. And you would think that in this pack of 17 slides and very dense, I would have put every chart in here, but I don't have one chart, and I want you to imagine it for a second. Think about an axis, a y-axis that is showing you volatility, and an x-axis that is thinking about leverage. And I want you to think about what a stock would look like, or a set of stocks, or security returns along that line. Is it a positively sloped line, which is what you would imagine? I think that as you get more leverage, you actually get more volatility in that stock. The answer is actually not. What we think about as leverage contributing to volatility is not really true when you examine that in the public market, so we might not expect it to be true in the private markets as well. Getting all of that information is difficult. So what we've thought about is, how do we quantify how much what your asset allocation should be in the private market sense? And to do that, I think it's personal for every single fund, every different investor's fund, because you need to be able to quantify what use you have for liquidity. Liquidity can be used for all sorts of things. You need to pay your liabilities in the future. You might be very good at dynamic asset allocation, or have that offensive ability to go out and buy and sell things to take advantage of dislocations in the market. Or you might be able to rebalance, a defensive use of liquidity, and be able to get back to an optimal weight when the market moves against you. But you can quantify all of those things with a shadow asset and a shadow liability, and by doing that, you can attach those benefits, or those benefits of the use of liquidity onto your uses for each of those things. And then I can think, instead of thinking about what my optimal allocation to private markets or private equity would be, thinking about the asset class like everything else, I can think about it once I start adjusting for fees and the fee differences and the smoothing of volatility and the uses of liquidity, that might be much smaller or much greater than I would normally think about. So it's a framework for actually quantifying what my use of liquidity is in order to put illiquidity into the portfolio. And then finally, the last thing is a process approach. And in this process, I can think about, I've got mean variance analysis, which we talked about a little bit, which is statistically rigorous. The problem with it is it's not very intuitive, right? It's very difficult to explain to people why I'm choosing some kind of allocation to various assets based on expected risk and expected return. Scenario analysis is much more easy to explain and much more intuitive. I can say I expect inflation to go up in the future. I expect growth to go down in the future, and this is how I map that onto assets. The problem with that is that we see that there is a lot of contemporaneous relationship between economic variables now and returns now. But what we don't see is the same kind of relationship of economic variables now and assets in the future. So what we really need to do is project what the relationship, what the variables are going to be in order to project what the impact on asset prices would be. That requires some probability weighting. And I'm not going to have a whole bunch of time to finish this one off, but just to think about how we think about the unusualness of that whole situation, of estimating how unusual economic variables might be in the future, or that set of economic variables. We borrowed a statistical method from an Indian economist, statistician, archaeologist from about 100 years ago, who was investigating where skulls belonged when digging up tribal sites. And this idea was that instead of looking at how far away from the center of the tribal site the skull was, they could do a multivariate distance by looking at all these different characteristics of the skull and seeing how far the current skull that they found was from the normal skull characteristics, multivariate distances. So in the end, we can do the same approach for looking at economic variables. We can look to see that economic variables, how likely or unlikely or unusual is it to see some inflation go up in the future, and then how unlikely or likely is it that inflation goes up, yet economic growth and unemployment don't. So by using that, we can project that future and a future state, and then probability weight the rest of what returns might look like in a robust or weak environment to help us with that picture. So I'm going to stop there and pass it on.
Thank you very much, Dan. If I can ask Emma to give us her thoughts.
I'm hoping I've got some slides.
Yeah, is it loaded?
If not, I'm happy to talk otherwise. There we go. We'll start with this one. I'm here today to share with you some of my insight and experience on the risks and challenges associated with asset allocation and the role it plays in the investment decision-making process, both in theory, but also more importantly, in my opinion, in practical terms. So my background and experience is in investment risk predominantly, and so I have a very biased focus towards data and implementation. So apologies from the start, but that's where my presentation is going to be focused. I'm hoping that at the end of the presentation, I will have given you some questions or some tools to take back to your own investment teams about what your particular business's asset allocation practices are and how you can optimise them to be better informed. What I would like you all to consider is that asset allocation models are not merely made up of mathematical algorithms or equations and economics, but the models are built on data and that interrogate that data. That data has flaws and it has complications. Flaws in cleanliness, timeliness, accuracy, actionability, and complications in how you capture, you store, and you make available that information to your investment team so they can make better investment decisions. So, as Dan did, let's go back to the very, very beginning. Active portfolio management is essentially two things: stock selection or manager selection, and asset or asset class allocation. Now, most managers, in my experience, put more time and energy into stock and manager selection at the detriment and the expense of asset allocation decisions. However, historical research would show us that you can be the best stock picker in the world, but if you get your asset allocation decisions wrong, you will inevitably underperform. So where should your asset allocation focus be? I'm going to talk to you about the models, then about the data, and finally about timing. So, as Dan mentioned earlier, Harry Markowitz was given a Nobel Prize for his ideas and development of finance theory, and to my knowledge, no one has yet come up with a better portfolio construction paradigm since. His finance theory tells us to optimise, trading off expected return against risk to create efficient portfolios. Now, this paradigm assumes that markets are efficient and that we are only working to trade off expected risk versus return. So I ask you firstly, who thinks markets are efficient? And secondly, can anyone think of other factors besides expected return and risk that play a part in portfolio construction? Transaction costs, data availability, tax status. So the maths has flaws, and when applied to the real world, but we still use it. So this perfect model that we're all searching for, there is no magic equation, there is no perfect formula to construct an asset allocation model. Every model uses assumptions, and those assumptions can become the constraints or liabilities in the predictors of the model that you use. So, just lean a little bit closer there. For example, the perfect asset allocation model could be a combination between momentum and value, so limited to 2 inputs. Should we add in a third? Size. A fourth? Liquidity. A fifth? Volatility. Where do you stop? So far I've been talking about a particular model that weighs off expected return versus risk, but there are others. Cap weighting, equal weighting, attribute weighting, risk premium, risk parity. The model that you choose will influence the outcomes that are derived, and each will be different and give different results. Let's think about that. The model you choose will determine the weightings in your asset classes. Choose a different model, you'll get a different result. So next we want to talk about what goes into these models. The data. Every manager I have ever spoken to has a story about the perfect stock, the one that got away. Everything from a tech bubble security to more recently cryptocurrencies, or even commercial cannabis companies that increase 100-fold after legalisation passed in Canada. If only the manager had gotten in at the start, they'd be cruising around the Bahamas right now. What the manager won't tell you about is the 100 or thousands of other securities that didn't have this 1 in a million valuation increase. Survivorship bias is inherent in any model because of its very nature. The companies that didn't have a 100-fold increase just didn't. In terms of asset allocation, decisions on what to do with outliers can be the difference between a positive signal or a false positive signal, and that's really important. So where do you get your data from? It doesn't grow on trees. That would be much cheaper and a lot easier. However, it has become easier to source reasonable sets of large data to derive meaning and trends and patterns and predict outcomes out of this data. But even big data has flaws. Imagine for a minute you're standing at the bottom of Mount Kosciuszko looking up at the summit. Your hypothesis? I've just discovered the biggest mountain in the world. I've got a map of Australia in front of me. That's my data set. I check all the points on the map. I'm pretty sure I've done it. I'm pretty sure I've discovered the biggest mountain in the world. And yet I'm not even close, not even in the top 100. There's a flaw in this. Unless I use every map in the world as my data set or my data universe, I'm going to miss Mount Everest for what's right in front of me. Now, including every data set in your model is not realistic or practical. But what I'm suggesting is just being really mindful of potential local minimums or local maximums, so you don't risk missing out on the obvious with a much shorter data universe. And lastly, timing is everything. Let's look back to a decade ago. Growth assets have done really well. Move forward to 2 years ago, and you're starting to feel that growth assets are a little bit overvalued. So watching the markets, move forward another 12 months, and you feel that growth assets are getting really overvalued, and so you decide to take an underweight position. Transition your asset allocation away from growth assets. Now, move forward to today. Your portfolio has seriously underperformed, and it's underperformed your peers as well as the benchmarks. You sound like a broken record. The crash is coming, the crash is coming. What do you do? How long can you hold your nerve and persist in an unfriendly environment? Or, if the pressure gets too much, do you risk locking in that underperformance, guaranteeing that underperformance, and potentially even missing out on the upside when the correction does occur? However, by the same token, you can miss the opportunity by moving too slow and changes in your asset allocation decisions become implementationally, if that's a real word, unable to be brought into the portfolio because they're prohibitively expensive. So being very mindful that it's not just the when that's important, as well as the what and the how. And finally, asset allocation is fraught with issues. The very premise of portfolio construction paradigm is flawed. The models are flawed. The data is an ever-increasing challenge. But asset allocation is essential to portfolio construction, and it's proven to deliver better returns for members. So I challenge everyone here today to talk to their investment teams about the asset allocation practices, how you can optimise, but being really mindful and considerate that the limitations of portfolio construction and the paradigm-efficient markets. Acknowledging the assumptions that you're making and that you're putting into the model, because those assumptions make it by no means perfect. The data itself comes with flaws. And finally, timing is everything. Asset allocation is really important, so it couldn't possibly be easy.
Thank you very much, Emma. Raewyn, you're up.
Thank you. I think Dan's and Emma's presentations have actually touched on my focus for today. Really, the cheeky title of my presentation is "Are we there yet?" And we all know the answer to that. It's no. But it's really a way of saying let's think about where we could evolve what we know is a very important part of portfolio construction. What are the weaknesses in the framework, and where do we go from here? My starting point is to remind us that we're really destined to practice asset allocation like every kind of investment practice within superannuation in an imperfect environment. So in a perfect world, we would have perfect information about our members' objectives, needs, risk preferences, liquidity appetite and retirement plans, and we'd have that perfect information from each member, and we'd couple that with perfect financial literacy. That's the perfect world in which we'd love to practice asset allocation, but the real world means we're navigating between two imperfect environments, and that is either the member takes asset allocation and the switching decisions into their own hands, and that probably means perfect information from the member coupled with imperfect financial literacy, or else the member leaves it to us to make the asset allocation decisions inside the fund, and so we couple our perfect financial literacy with imperfect information about the member. So ultimately we do our best in terms of asset allocation in that framework, but it is a reminder that we're trying to close the gap between imperfection and perfection in order to get our asset allocation decisions closer to exactly what each member needs. So let me just run through a bit of a list of some areas where we still have weaknesses to deal with in an asset allocation sense, and we will have the opportunity, I'm sure, in the discussion after this to drill down where some of these pique your interest, or perhaps even I throw some things out that you vehemently disagree with. That would be great. So let's start with something that perhaps is not a controversial contention, and that is that we don't really have to use the current ways that we group asset classes. We really define an asset class in a somewhat nebulous way as a group of assets that are expected to behave in a particular way in the market, and perhaps have a particular legal structure and set of rules and regulations that apply to those assets. But there are a number of ways that we could group assets together into what we might call an asset class. We could group them by risk premia, by macro themes like sensitivity to interest rates, so population growth. We could group them by yield, geography, duration. There's a number of different ways that we could group assets together and call them an asset class in a way that actually empowers us. And I do want to say that probably the worst excuse that we could offer in terms of sticking with the existing ways that we define asset classes is this is the way we've always done it. Perhaps the second worst excuse is this is the way our peers done it. I think we actually do have the opportunity to think a bit more creatively about how we even define asset classes. We also know that some asset class categorisations are controversial, so where does property sit? Infrastructure, long, short, equity. I think it was IFM yesterday that talked about classing lower grade or higher risk credit as a growth asset, but some people might throw that into fixed income, which is thought about as a defensive asset classes. So, we're not even clear and we can't even reach a consensus on some assets that are actually in just about everyone's portfolio. And some give a false sense of diversification, so a somewhat sort of strange portfolio, but think about some Australian equities, some what we used to call listed property trusts or REITs, some commodities, maybe an emerging market index exposure, which we all know is very China heavy. It might look to us like we've got a diversified portfolio, but we actually know that the correlations between all of those things are quite strong. So it might actually be giving us a false sense of diversification just because all of those assets actually tend to fall into different asset class boxes. Something else that has already been touched on by Emma, I think, was that the fact that we are very peer sensitive and we are judged compared to how our peer funds are going means that we have these imaginary asset allocation rails. And this is not just a theoretical issue, because we know that it's really hard to generate investment returns. These are really difficult investment times. What we really love to do is take a piece of information that we have a high conviction about and implement it in a portfolio. But because of peer sensitivity, if we have a really high risk about really high conviction about a particular asset class, we can't necessarily go there and implement it because it might feel like we're too different from our peers. So it's a valuable piece of information that's actually wasted in an asset allocation sense because of the peer sensitivity of the industry. So, just running through again a list of things that we could work on around asset allocation. We have a lot of things, and this is not at all an exhaustive list, a lot of things that just don't fit into an asset allocation box neatly. What about equities that are now using some call writing to boost yield, or put selling or put option buying? Where do those sit in a portfolio? They can be high beta or lower beta, so it's hard to know whether to sit those in equities or something else. Lower grade, high risk credit, I've talked about that. Multi-asset, there are multi-asset strategies as part of a broader trend coming on the market. How on earth do you fit that into an asset allocation box? And then there's this idea that we only think about particular sector allocations in terms of the inputs that we've heard already mentioned. So expected returns, some kind of risk like standard deviation, and the covariance matrix that are the sort of the key inputs. What about other important initiatives in a fund, like we might broadly call them implementation initiatives or a move to an after-tax focus? How do they sit in an asset allocation framework? They don't sit neatly into the way we currently approach asset allocation. The survey question has already prompted some initial thoughts about more dynamic asset allocation strategies. Again, you might have a lot of conviction that they can add value, but they are limited ultimately by your capacity, your governance capacity to actually support more dynamic decisions around your asset allocation. And one bugbear of mine, or one way that I think we can do better, is that we really must improve the way that we factor in the implementation costs of changes in our portfolios. So we have these models that might tell us to downweight equities, upweight fixed incomes, but there's too many models out there that don't actually factor in the transaction and tax costs of actually making that change, and that can make a real difference to the decisions that we make. Something that I was reminded of recently is that I got to look at an academic working paper from one of the universities down here that was trying to assess the industry's ability to add value through asset allocation, and it's great to open ourselves as an industry up to rigorous, robust external research. But the problem with asset allocation is that some of the switching behaviour is driven by us as a fund. We'll make an investment decision to change asset classes, but some of it's taken out of our hands, and it's the members underneath it that are changing options. And so whether we think that's a good decision or not, that's driving some of the changes between asset allocation. So this idea of how good we are at asset allocation doesn't lend itself easily to external examination and verification of our success. A couple of things to finish. The first is that in this world where we are really trying to get at particular member objectives or member cohort objectives, if you think about it, now the asset allocation paradigm doesn't map that well. And so let's, for example, take a 50-year-old member. So they're starting to think about retirement on the horizon. They've got a reasonable balance in their super fund account, so they're interested in capital protection. They still they're worried about sequencing risk. They still need some exposure to growth assets to manage longevity risk. They're starting to figure out how much liquidity they need. Well, there's a set of things that are really important to the member, and then somehow you've got to map your existing asset allocation boxes, which are just asset classes and maybe labels, growth, defensive, against these really specific preferences and objectives of members. You can make them fit, but they don't map that easily. You've kind of got to decode what you're doing there. And so perhaps we need to evolve asset allocation in a way that more easily and intuitively maps to the way we describe what our members care about and member cohorts care about. And to finish, I want to say that we have to be careful that asset allocation isn't a victim of its own success, and I think Emma raised this point, and Dan talked about one way that it can be evolved. I mean, it is this it has its own momentum, and it has quite a powerful anchoring effect. And so I have been privy to a number of discussions where you'll have a good investment idea and we'll all agree it's a good investment idea, and then you spend the second half of the meeting talking about which asset allocation box it fits in. Well, you do need to have that discussion, but in the end, it's actually not about whether it fits in a box. If there isn't a box where it fits easily, but it's actually a good idea, then just make it fit or find a new box or change the paradigm. So asset allocation isn't the end, it's a means to the real end, which is delivering really good outcomes for our super fund members. And to Emma's point, sometimes we stop at the shoreline and we don't give ourselves the excuse to get inside those boxes into the data that's feeding our asset allocation decisions. So expected returns, some sort of risk measure, standard deviation, and covariance. Sometimes we're so busy trying to keep up and feed the hungry maw of asset allocation with all the data we get in that we never actually find the time to actually think about whether they're the right inputs and whether there are ways to improve the data that we're putting in. And finally, I'll leave you with really the reverse idea that in keeping up with that treadmill or that hungry more of asset allocation that needs to be fed, it's not just about making sure that we don't occasionally go further into thinking about those inputs, but occasionally we get to step back and look outside the asset allocation framework. So let me finish with one example around that. One thing that we've heard a number of times in this conference so far is that it's a really uncertain world. Maybe it's really hard to trust the old models and predict what's happening next. But, what we run the risk of as an industry is going back, even though we all agree around the board table or IC table, that, wow, it's really hard to predict what's going to happen go forward, but we just go back to our old ways and we still continue to plug things into our asset allocation framework, even though we have much less conviction about those different asset allocation bets. So we need to find a way as an industry to step back and say, do we actually need to change the paradigm around asset allocation? Do we need to sort of sit above that and say, for example, if we can't predict returns going forward, if we can't predict asset classes, we can't trust the data, how would we do portfolio construction differently? Now, I'm not saying that we necessarily should blow everything up and start again, but I am saying that we do need to find room to have that conversation and ask those questions rather than just slavishly following and continuing to implement the same asset allocation paradigm over and over again. Thank you.
Thank you. I'm going to get straight to questions from the iPad, and also if you've got a question, put your hand up and a mic will come to you, because the first and most popular question that I've got here is actually one that I was going to, goes to one I wanted to ask, except of course because I'm outside the industry I was going to ask it the other way around. The question is, even if you had perfect info for a member, you can't build a perfect portfolio to meet their needs. How can we dispel the myth that personalisation is possible? I'm really sorry, but I thought that in 20 years' time, AI was going to mean that you would be able to give me a completely bespoke, perfect investment option.
Today?
No, not yet. We're not quite there yet.
But your perfect allocation today, or your perfect allocation in 5 years, or your perfect allocation at the end of your career and when you retire, because the members change, their needs change, the model has to change as well. So you would end up having to update it all the time.
So how do you dispel this myth then, that people are going to get a personalised product?
By looking at the value that they would get if they did. And I would argue that a personalised product, the cost involved to implement such a strategy would then be detrimental to the ultimate returns that they would receive at the end. By being able to be part of a group, and yes, a tailored group, you would actually end up with better returns for your member.
So can I say that we shouldn't give up on that aspiration of coming up with a perfect, it's close to perfect customised experience on a per member basis. So I think that we don't know how far these technological advances are going to take us. We don't know how much we'll be able to expand and take in data. We don't know how much our member engagement initiatives will have traction, but all things are possible. And so, I would say that we should set our aspirations quite high as an industry about getting as close to possible as close as we can to a sometime in the future to a per member customised outcome, and we treat it like a stretch target. So we may not get there, but it'll get the best out of us as we try.
One thing to add here is I think that what we're trying to do is when we say personalization, we're trying to put more definition into the perfect foresight, right? And we might have perfect foresight just in terms of that question of 10 years from now, but it doesn't mean we know what the whole picture looks like within that horizon. So I don't know if there is a different outcome of one person to the other. Why would somebody want less return than somebody else? What they want is how I framed it before is that, remember, risk tolerance is setting the price of risk, expected risk, in terms of that expected return. So what we want to know is how we can better understand the path of that risk and what the risk tolerance for each individual is. An individual or a sovereign wealth fund, their goals aren't that much different, right? It's just that their view of risk is different. One can tolerate intra-horizon risk much better than the other.
But isn't it integral to that engagement with funds? Because you talk about different risk appetites over an 18-year-old versus a 30-year-old versus a 55-year-old. But what happens is people put their money into a super fund, into whichever fund it goes into. How many actively change it as they go through life? And it's not like you guys contact us and say, oh, look, you're turning 50 next week. You might want to move out of this high-risk volatile fund and move. You don't. I mean, and so isn't that something that you could do in terms of marrying risk profile with individual customers? That's not hugely difficult, but take slightly more onus in making sure people understand that they need to moderate depending on where they are in their life cycle.
It is happening, right?
Yeah, I think that's life cycle strategies are one way the industry is addressing it, to say have some automatic de-risking and using age as a proxy, and then there are some even more evolved life cycle strategies that are starting to use other characteristics than age to set different asset allocations based on risk appetite or inferred risk appetite as members go through the fund through that journey. So that's a great step forward. The other thing that we are doing as an industry is we are trying to get members more engaged, to feed us that data and understand where they're invested and understand their options to switch to something that fits their risk appetite better. So they are initiatives that had some traction and will continue. I did read, I think, last week about CBUS trialling something very successfully around communicating to members their account balances in terms of future salary replacement in retirement, and that's not a new idea at all, but that's just some of the low-hanging fruit, I think, in the industry that we sort of actually are finally getting onto, that will help members actually start to own their superannuation outcomes rather than it all being on our shoulders.
Can I add to that very quickly? We're still talking here about expected return and risk. In my experience in conversations, there are other things that we need to consider here. So ESG is a great one. It's no longer talking to members. They're not just interested in the best return that they can get for their risk appetite. They also want to know about what's the sustainability of their portfolio. What are they doing? What is the manager doing? Or we are these big institutions with a lot of sway. What are we doing to make the world better? And they are willing to give away some alpha to do that. So I think that conversation's going to increase going forward, and that's something we need to take into consideration when thinking about asset allocation.
Because you'd hope so, because I think the number is something like 58% of people between the age of 18 and 34 don't open the communications that they're sent by their super fund. Just completely ignore them. Doesn't say a lot for engagement. Question here, is RG97 shaping asset allocation to cheaper asset classes and more passive type exposures? Is this going to detract from long-term alpha generation?
RG97 is an interesting one. It's about transparency. It's about the member understanding where the fees are coming from. So yes, it's going to have an impact, but it shouldn't just be the bottom line that the member pays less fees and therefore it's a better fund for them. There is this trade-off again with what are they getting for those fees? So passive strategies are passive, active strategies are active. They are different beasts and they have different purposes, and so have different places within a portfolio.
Is there anyone else want?
Yeah, I mean, we went through a period of time where we thought pay more, get more, right? And that drove a lot of different pricing models into some crazy territory. A lot of that's already pulled back, right? The question is, there's nothing implicitly wrong with that transparency into the fee cycle because, or the fee schedule, because we really need to understand what, where it is that those charges are being made. But if you can still continue to prove that your fund is worth it over the right time period, that shouldn't impact that, I don't think.
That actually links nicely, I think, to the next question in terms of time periods. Are mid-risk asset classes like infrastructure and property going to be more prominent in portfolios in a lower for longer? Sorry, the question just changed on me. But look, I'll go to the question I was going to ask you. Volatility is at the heart of asset allocation models. Should we be concerned with short-term volatility as long-term investors? Are the models flawed? That's not my question, so don't look at me like that.
It's a high-level answer, but I'm sure it's obvious that no, we shouldn't. But in practice, we have members and we have other external people, stakeholders scrutinising us, and they're actually imposing a bit of a short-term view on us. So we can take the high moral ground and say, this is inappropriate, we're long-term investors and it would be great to take that high moral ground, but we are really victims of some short-termist behaviour from our members and from others in the community that won't sort of give us the licence to really adhere to that long-term view.
And what are the sources of the errors here? If we just think about estimation and estimation error, the sources of the error are small sample error, we're looking at something too small, independent error, meaning it's not related to something else that we're looking at, or interval error. And interval error, I think, is what we're talking about here, is that we're looking at, we expect that correlations are stable through time and that risk or volatility scales with the square root of time. That's built into all of these different risk models. It's just not true. We know that now, that we need to really understand what are the sources of these interval errors, and that we can make better modeling. But it doesn't mean we shouldn't pay attention to short-term volatility. It just means we know it's not linearly related to longer-term volatility.
Now I'll go back to the question I started reading before. Are mid-risk asset classes like infrastructure and property going to be more prominent in portfolios in a lower for longer risk-free rate environment?
I mean, it's really hard to answer that question. I think that what we will see is that we'll see certainly a sort of a slide up the risk curve, so from low risk to mid risk, from mid risk to high risk, and that's particularly the case if looking at sort of APRA's proposals to compare funds on a return basis and not necessarily a risk-adjusted basis, or not have risk metrics in there, then what actually allows us to factor in the level of risk that we have for the unit of return that we're pursuing. We're actually heading in the wrong direction based on external regulations. So, yeah, I do think that anything but low risk assets, that there's a place for those in the portfolio, and they might actually be exactly suited to what a particular member cohort wants, but it's actually going to be hard for us to really sort of toe the line on that when there are too many incentives to slide up the risk curve.
Let's finish with a question from the floor, which...
Thank you very much. Thanks, Ali. And just an easy one to finish off with, and thank you for sharing your insights with us. A few of you have touched on this, actually, is that people would think that when you're doing portfolio decomposition or if you're breaking up your portfolio and how to invest it, that using asset classes is an intuitive and historic and relatively easy to explain method. But a more appropriate and sophisticated way would be actually using risk classes, or sometimes called risk factors, if you like, and actually breaking down your portfolio into those rather than asset classes. Do you have any thoughts?
Yeah, I think that it's just a flip side of the coin, really. When we think about asset classes, what makes an asset class is that I would define it as it's intrinsically homogeneous, extrinsically heterogeneous, right? It's at the same time both of those things. which means that they're not close substitutes for each other and they actually do that diversification. When we think about the risk budgeting or the risk allocation, the problem is that risk isn't stable. Risk is the intertemporal nature of risk means that when you're judging any of those assets or whatever it is you want to flip the coin on, that is a point in time estimate of that, which changes very rapidly. You can think about that from before the financial crisis to after. If you took a 60-40 portfolio in 2007, standard deviation would be about 7 or 8. That's exact same portfolio, the same assets in 2009 is 30, right? So that the nature of that is, you're flipping around. No, the problem is estimating what goes on what becomes much harder when you're just looking at the risk side. It's not a wrong answer. It's just I think you need to. It's just the flip side of the coin. We need to understand that you're doing the same estimations because it's the asset classes that are heterogeneous extrinsically.
We are out of time. I just want to finish by putting you on the spot, literally with about a 10-second answer, which is going to be almost impossible. I appreciate that. What's the biggest mistake you either think is made or you may have seen being made in asset allocation? Biggest mistake, Raewyn?
I think to say that getting our manager selection and everything inside each particular manager's allocation is sort of the micro level, and then the macro level is asset allocation, looking over the top. Because actually we're missing the top level, we're missing the level above asset allocation that says, what about all of these things that are bigger than asset allocation that can really drive value in a portfolio?
Emma?
Data. Always comes back to data. Know what's under the hood. Because until you really know what your exposure is, you can talk about asset allocation, but it may not be true to label.
I think it's just the misspending of time. And when you have a finite amount of time to allocate, Emma touched on this too, that probably a huge multiple of the time that goes into manager selection is versus asset allocation decision itself. If you get the beta wrong, getting alpha is not that interesting, right? You need to get that construction right. And spending, I just don't think people spend enough time in comparison to what they're doing in other aspects of the investment process.
Now, in lieu of speaker gifts, as with the other sessions, a donation has been made to the First Nations Foundation, which is supported by Holding Redlick. Please join me in thanking our panel for their insights very much.